Trump has had a very eventful first few weeks in office, and we finally got a sneak peek on what his tax bill might actually look like. And there were a couple of surprises here, a few tax proposals that were not mentioned on the campaign trail, and then a few that he did mention on the campaign trail that seem to be missing from this list. So here's what Press Secretary Caroline Leavitt had to say about it.
So these are the tax priorities of the Trump administration that the president has laid out for members in that meeting today. No tax on tips, which is obviously a very public campaign promise that the president made. No tax on seniors' Social Security. No tax on overtime pay. Renewing President Trump's 2017 middle-class tax cuts. Again, these are the president's priorities. Adjusting the SALT cap, eliminate all the special tax breaks for billionaire sports team owners, close the carried interest tax deduction loophole, tax cuts for Made in America products. This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done.
So if you've been following along, that you know that the no tax on tips proposal is no surprise here. That's been a huge focus. I think that has a pretty good chance of passing. The number of people who actually collect tips and still pay federal income tax is relatively small, which means that this is probably one of the cheaper tax proposals from a federal budget perspective. And then we've got no tax on seniors' Social Security, which Trump also campaigned on. Now, what's interesting is that she said seniors' Social Security. That wording makes me wonder, does this apply only to Social Security retirement benefits, or would it also cover SSDI, which is Social Security disability income, or survivor benefits, because those aren't necessarily collected only by seniors. So that part isn't clear yet. Now, Thomas Massie just reintroduced a bill in Congress called the Senior Citizens Tax Elimination Act, and that bill would fully repeal the part of the tax code that subjects Social Security income to federal taxes, which would include SSDI and survivor benefits. So I imagine the goal here is to completely remove Social Security income from taxation, regardless of who's collecting it. Because when you think about it, Social Security really is taxed twice, and that's a big pushback against it, pushback for eliminating the tax on it, because you pay federal income tax on your wages before you contribute to Social Security, and then when you collect those benefits later on, you pay taxes on up to 85% of them if you're over the income threshold. So this bill would fully eliminate that second taxation of it. Now, that does raise the question about Social Security funding. That's a whole separate issue. All right, and then we've got no tax on overtime pay, which Trump also campaigned on. No surprise there. And then, of course, maybe the least surprising of this is he wants to renew his 2018 tax cuts before they expire at the end of this year. So this would extend our current tax rates rather than going back to the higher 2017 tax rates. It would keep the standard deduction where it's at instead of getting cut in half. And then there are several other provisions that were in that tax bill that are set to expire, like the higher child tax credit, the QBI deduction, the estate tax exemption. I assume those would be included in that, but he didn't specifically mention that. And then he also campaigned on adjusting the SALT cap, which is currently a $10,000 cap on the amount that you can deduct for state and local income taxes if you itemize your deductions. That's very important for high income tax states. They've been pushing for that. So that could get raised or removed entirely. So we'll see on that. Now for the interesting part. So Trump's plan here, it sounds like it includes two new proposals that were not part of his campaign messaging. And I'll explain both and why this matters. So the first is eliminating tax breaks for billionaire sports team owners. And the number two is closing the carried interest loophole. Now, these would actually increase revenue as opposed to the others, which would cut revenue. And that makes sense because they're probably trying to balance those tax cuts. So they need to bring in some revenue from somewhere else. So let's talk about these sports team tax breaks. I believe this is referring to a bit of a controversy that came out in 2021 showing how massive the tax deductions are for sports team owners. So here's how it works. When you buy a building or a large asset, you're allowed to depreciate or take a deduction for the cost of that over several years. The number of years depends on the type of asset that you're purchasing. That obviously reduces your taxable income for the next several years. That part's not unusual. Businesses and real estate investors do this all the time. But sports team owners get another big tax break. They get to amortize or write off the value of intangible assets. So this includes things like the value of player contracts, brand recognition, broadcasting rights. At the time of a purchase, these things are assigned a value, and the owner can deduct the value of that over 15 years. So between the depreciation of the physical assets and the amortization of the intangibles, this allows owners to deduct almost all of the purchase price over the next several years. even though the teams are making a huge chunk of money. So from a tax perspective, with these deductions, they could be showing a loss or a much lower profit than what they're actually cash flowing. Now, it is worth noting that when the owner sells the team, they'll have to pay taxes on those deductions that they took throughout. So it's more of a tax deferral than an outright tax avoidance. But eliminating this provision, or at least the amortization portion, could bring in a lot of tax revenue up front for the government, which could help offset some of the other tax cuts that Trump is proposing. And then we have the carried interest loophole. Now, this is a tax provision that allows private equity funds, hedge funds, venture capital managers to pay a lower tax rate on their income. So like normally when you make money from a job, it's taxed at your ordinary income tax rate, which could go as high as 37%. But investment managers get to classify a chunk of their earnings as carried interest, which is actually taxed at the lower capital gains rate, which is capped at 20%. So this loophole has been controversial for years, and there have been many attempts to close it. Trump's plan here suggests that some or all of that carried interest income would be taxed at ordinary rates instead of the capital gains rate. Again, this is not something he campaigned on, but it might be necessary to help get some of the other tax cuts through Congress. And then one more that was on that list was tax cuts for Made in America products. Not a lot of details on this. I assume it means manufacturing tax credits to incentivize U.S. production. So we'll just kind of have to wait to see what the specifics are on that. And then there were a few tax cuts that Trump mentioned on his campaign trail that were not listed here. One of those being lowering the corporate tax rates, making auto loan interest deductible, tax credits for family caregivers, and then extending bonus depreciation, which may be included as a part of extending his tax cuts. We'll see on that. I'll keep you updated as more details come out. So if you find this helpful, please like and subscribe. Thanks for watching.